Okay, so let's take a look at Tesla here. Trading right now at $215 per share. It's a 685 billion market cap company, and of course, everybody knows Tesla for being the pioneer in the electric vehicle industry. But they also have other products that are focused on accelerating the world's transmission to renewable, sustainable energy. Over the last year, we've seen quite a bit of volatility in the stock. So year to date, it's up a tremendous amount, almost 100% over the 12 months. A lot of volatility, a lot of ups and downs, trading just about flat. But just recently, the company has seen some weakness in its share price. When we look at the 1 month chart, it's down about 20% over the last 2 weeks and down 16% since the release of their Q3 2023 financial results, which was on the 18th of October. So let's take a look at some of the financial highlights here. Automotive revenues were up year over year at 5% to 19.6 billion, but down 8% compared to the most recent quarter. Energy generation and storage revenue up 40% to 1.6 billion. Services and other revenue up 32% to $2.16 billion. We're seeing very strong growth on a percentage basis year over year in energy generation and storage and other services. However, they continue to make up a relatively small percentage of the company's overall revenue. Total revenues, $23.3 billion, up 9% year over year, down 6% compared to the most recent quarter. Adjusted EBITDA was down 24% to $3.76 billion compared to last year, down 19% compared to the most recent quarter. And we've seen some pretty considerable weakness in the margins. Adjusted EBITDA margin was 16.1% in the third quarter of 2023. So that's down 706 basis points compared to last year and 260 basis points compared to Q2 of this year. And then adjusted EPS, 66 cents per share, down 37% year over year and 27% quarter over quarter. Now, looking at some of the operating highlights, the Model S deliveries were down 14% compared to last year, down 17% compared to the second quarter. The Model 3 deliveries were up 29% last year and down 6% from the quarter. So on a aggregate basis, total deliveries for the quarter were up 27% year over year and down 7% compared to the most recent quarter. Once again, we're seeing some strong growth, of course, in the storage deployed, up 90% compared to last year, as well as the number of supercharger stations up 31%. Solar deployed was actually down by almost half compared to last year. But again, these are very small parts of the company's business and not major contributors to revenue. So the company highlighted a few factors that impacted their Q3 financial results. One was a reduced average selling price due to pricing and the mix of products sold. So I'm going to actually look into this a little bit further in a couple of slides because this is very important. Increase in operating expenses driven by the Cybertruck, also investments into AI and other R&D projects, and also the cost of production ramp up and the idle cost of factory space as they've expanded their factory capacity. So just on the topic of the Cybertruck, the long-awaited Cybertruck, that is expected to begin deliveries in November of 2023. So long awaited, but we should start to see it contributing to profitability in 2024, according to Elon Musk. So if we look at a historical chart of Tesla's deliveries, we can see absolutely phenomenal and consistent growth over the last several years, especially in 2021 and 2022. Now in 2023 for the third quarter, deliveries up about 27%. So we're still seeing fairly significant growth in deliveries, although it does look like it is slowed somewhat from the strong numbers in 2022. But what is really concerning to me is that deliveries are up by a quarter over a quarter, and yet revenues were only up 5%. So why is that? This really comes down to pricing. So one of the things that Tesla has been doing in this market is they've been reducing prices. We can see that the Model S, which started the year at $104,000, the price has been reduced to about $75,000, and the Model X starting at $121,000 reduced to about $80,000. So there have been some pretty considerable reductions in the cost of these products. Now, this may also be due to new models coming out. the Cybertruck is coming out. So that could be a contributor going forward, depending on how it is received. But this is generally not a good sign. When you have a competitive advantage, when you have a highly coveted product, having to reduce your prices many times throughout the course of a year, and by a significant amount, really is an indication that there's more competition coming into the market. People are more price sensitive, or perhaps they're not as excited about your product as they once were. So this is something to keep an eye on. Delivery is still strong, but revenue growth has really slowed due to these pricing changes. On a balance sheet basis, the balance sheet looks great: 23 billion in cash, 1.4 billion in debt, so almost 22 billion net cash. That's fantastic balance sheet. And then analyst estimates and valuation. How much is the company expected to grow? Well, based on the average analyst consensus estimates, they're looking at 318 in earnings per share for 2023, and then growth to 398 in 2024. So this year, analysts are actually expecting about a 20 to 25% decline in earnings per share, and then about a 25% increase in earnings per share next year. But we see, based on price to earnings, the company's valuation for this year, expected earnings would be 68 times this year's expected analyst consensus, and then dropping to 54 next year. So we're seeing, in spite of what appears to be some pretty serious uncertainties, at least from my perspective, the company still trades at a very elevated valuation. So our take on Tesla, well, it does continue to be a market leader in a growing industry. There are opportunities that the company is taking advantage of to expand beyond just electric vehicles. We see they are contributing, although they're still a small percentage of the company's total revenue. One thing that I didn't spend a lot of time focused on is AI, how they are really a top AI company. They are a leader in the self-driving car space, although regulations have really slowed that down. But that is a leadership position for them. They also have a cash-rich balance sheet. But on the negative side, growth is starting to show signs of slowing. And certainly those reductions in product prices are a bad sign. They're having to do that in order to keep the deliveries up and keep their factories running. We're seeing a substantial increase in competition over the next 5 years. Virtually all of the major auto manufacturers are coming out with more electric vehicles. These are all companies that have more experience manufacturing cars than Tesla. So one of the things that Tesla has a great reputation for is just technology. One of the things they just don't have the best reputation for is just general craftsmanship in their cars, or at least so I've heard from people that have owned them. And then an expensive valuation relative to the current growth expectations. So you're basically looking at flat 2-year growth from last year to next year, yet still trading at the 55 to 70 times earnings range. So our take right now, we think that the valuation is too expensive. There's near-term uncertainty. Long-term, certainly there are opportunities that could exist with this company. In the technology side, depending on how they develop, how their non-EV products expand and start to contribute in the future, there's always a possibility that they're kind of going to come out with some breakthrough technology and really blow everybody's socks off. But there are other companies out there that also have similar potential, that are trading at a far more attractive valuation. So right now we're on the sidelines with Tesla.
Excellent job. Yeah, I like that you pulled up to just, where prices have moved or came from for each of their vehicles. Like we ended up highlighting them or including them as a monitor in our electrification report. Sign up to our webinar or our upcoming webinars and you'll get that electrification report for free. But Aaron kind of highlighted a few of the key points that I mentioned in there. Like one thing I say is, Tesla has cut prices to drive higher volumes and supposedly try to maintain market share, but we're continuing to see that market share slowly erode here. And Musk basically said the thought here would be to, cut some revenue growth on basically the vehicle sales, but potentially, get some kind of subscription based revenue for the vehicle autonomy later on. And I mean, me and Brett had a conversation about this previously, and I think he made a good point where, if you have another company that maybe isn't charging, a subscription for their vehicle autonomy, it kind of, undercuts Tesla if they do start charging, a monthly or an annual subscription. Like, we started talking about just BMW, for example. Like, look at BMW. I think it was 2 years ago where they were starting to charge subscriptions for like heated seats and, add-ons. And I just, how would that work? I just don't understand how that could work. And of course they did roll that back. But yeah, I think that could be a challenge. Like I do plot out in my report there on Tesla, just kind of the market share as well. And we've seen BYD Auto, based out of China, go from a 7% market share in Q2 of 2021 to now supposedly they're at 21% as at Q1 of 2023. So that's still kind of a little bit lagged. But we are seeing, potentially Tesla's market share get eroded. And of course, Porsche, Volkswagen, all of these companies are starting to, release their own vehicles as well. So, it might be hard to, maintain that market share. I agree with Aaron. As far as I've heard, Tesla has a wonderful product. But yeah, it might be tough to maintain that market share. And, of course, we're paying a huge valuation premium to, potentially, ride the stock or invest in the stock, when this is kind of looming overhead. And it could, it wouldn't be good if, market share continues to decline, of course. Anyways, that's my ramble.
I'll add a bit on to what I've mentioned, Brennan, before. The really big issue I see with Tesla is them bridging the gap between that enthusiast or luxury market buyer to the average consumer. And that's where you'll see that subscription come in. If an average person sees a subscription at, let's say, a couple thousand a year, they might go for a different vehicle because over the lifetime of vehicles, the average normally people will have, I think, about 12 or 13 years now. So that's the price of nearly a whole new car at that point, if you're going for a cheaper car. And I think you're seeing that as well with Tesla's Cybertruck. They're having issues with demand and production at this point. They're trying to release this unique enthusiast level product, and yet they can't really produce it at scale at this point. And it's hard to, I forget, I know they dropped the pricing on it. Brendan might know the pricing, but it's an expensive vehicle. And that's not going to really the average consumer, even the average premium truck buyer, might want to just go for the F-150 at that point because they're releasing competition.
Extremely ugly, just
and
saying.
it is ugly, and
really, really ugly.
It's a niche product.
It
is.
How dare you?
Yeah, one quote that, like, and I think this kind of scared the market a little bit. This is right from their conference call.
Aaron's quote right there. It's ugly. That scares people too. No,
I think that this is Musk saying this. Let me just, so this
is
Musk said it was ugly.
He says, I know a lot of people are excited about the Cybertruck. I am too. I've driven the car. It's an amazing product. I do want to emphasize that there will be enormous challenges in reaching volume production with the Cybertruck and then in making a Cybertruck cash flow positive. So, I mean, he's really kind of maybe, at least he's being transparent with the market, I guess. He's not like promising.
I mean, he may be forecasting out like a margin depression, basically through that.
Exactly.
Over the next few years.
It's not,
depending on how long the ramp takes.
It's not a high margin
18 months for the ramp
overall, right? Yeah. So like what were the EBITDA margins for the quarter? 16%. That's a low EBITDA margin. I mean, it's not.
And to like the sector valuations, to be honest, like the mean is like 12 times non-GAAP. Like this sector has not, like the automobile manufacturers have not traded at for decades any type of premium valuations. It's really a discount to the market.
Well, it's being valued as
many of them are, of course it is, yeah. But many of these companies, like Ford has for example, I mean, they have a ton of EVs. Look at their balance sheet relative to Tesla. Like it's an eyesore. Like they have 144 billion in debt and 29 million in cash. So like relative to the flip that the net cash position that Tesla has. But Aaron's right. It is being valued as a tech company. But do like some of the traditional manufacturers close the gap in between them? And then, and if you see reduced market share, can you pay 58 times earnings? It was earlier this year, Tesla, was 140 or something at some point in that range. It was starting to look more attractive, particularly if, at the start of the year, there was forecasted growth for EPS this year. Then it got cut back a bit. you were starting to get to a more 30 times, almost in that range, and it was getting a little bit more attractive, but it just bounced off there at the start of the year with all the other, essentially the mega cap 7 or 8 companies. And now you're paying a premium multiple, and we went over some issues. It's not that it's a horrible company. There's certainly worse companies out there, but you're paying that premium, and there is some, issues right now, and they're even being telegraphed quite specifically by the CEO or by Elon Musk himself, right?
Yeah, and like there was another, like I also in our electrification report, I also did a monitor report on BYD company, and like in my due diligence, a lot of the thing is that 2023 we're seeing BYD guide toward 1.75 million passenger EVs. And Tesla's, target is 1.8 million deliveries for 2023. So, analysts are guiding for 2024 for BYD to actually surpass Tesla here. So again, BYD is maybe taking that majority market share, and then like Ryan just said, we have all of these other competitors that are just household names already in the market that are starting to enter.